Hey everyone, welcome to another session of Inside the Markets with Caleb and Brown. Today we're going to recap what's happened in the month of August and what's in store as we enter the exciting month of September. So first, with an August check-in, we saw strong swings in risk assets throughout the month. That was really the main theme throughout the month of August, that sharp volatility in both directions. Jerome Powell's Jackson Hole speech was interpreted as a dovish tilt, hinting at potential rate cuts. All eyes are on September rate cuts at this point. That seems to be the next big catalyst people are looking for to really define, are we at the end of the cycle or are we just getting started? Bitcoin and Ethereum did rally throughout the month of August. Notably, Ethereum actually hit a new all-time high, only just, but it did manage to hit it. The reoccurring theme for the last probably 2, 3, maybe 4 years now is just the disappointment of Ethereum. It's not trailing and keeping that parity with Bitcoin. It's grossly been outperformed across numerous sectors. And the altcoin market, and alt season as we like to call it, is largely dependent on new inflows into Ethereum and high performance and new all-time highs. Seeing that all-time high, albeit very brief, is very optimistic for what's in store for the rest of the year. Be aware, volatility often spikes and macro narratives can flip quickly. We've got a lot happening on the macro side, geopolitical side, that can turn the switch on what people consider is good and bad in this market very, very quickly. So some of those topics there, we've got inflation, tariffs, and Fed policy. So the PPI, the Producer Price Index, shocked to the upside. It came out at 0.9% versus a 0.2% forecasted expectation, which is good. A key driver was tariff-related cost pressure on producers. Despite this inflation signal, markets are still expecting a rate cut nonetheless in the month of September. The Fed is caught, so you can either cool inflation without triggering a recession. It's a tricky spot to be in, and there's a lot of pressure from the President Trump from the United States. Labor market is softening, which also adds pressure to ease here. So the path of interest rates, a major topic here. So Jerome Powell's tone was quote unquote dovish but cautious. Do with that as you please. The market implied probabilities still favor a September cut. All prediction markets do also favor a majority prediction on a September cut. The degree of which that is A, going to be cut, and B, priced into the market already. That's the tricky thing here. If we already have a modest rate cut priced into the market, we may not see that swing in volatility. However, if rates are cut more aggressively than what the market is priced, then we could very easily see a lot of new inflows into the market and more of a bullish greed indicator coming back on. The Fed funds futures showing prices for cuts in late Q3 or Q4. So that's where things are really expected. And the rate direction is everything for crypto risk appetite. Rates going down, crypto upside. It's pretty black and white most of the time there. Liquidity sensitive assets like Bitcoin and Ethereum will respond sharply to the Fed language. You would have seen in the past when Jerome Powell gives his speech, you can see markets fluctuating up and down, and you can see people trading with leverage getting caught on either the upside or more often than not the downside in those situations. So doubling down on Ethereum here, I'm very happy to be actually speaking positively about Ethereum for one of these sessions. It's certainly been a while. Ethereum closed August 19% up from $4,374. It had an all-time high of $4,900 within the month. Institutional appetite is surging. So there are numerous corporations that are now adding Ethereum to their treasury holdings. We started with Bitcoin, we migrated into Ethereum, and then if history does repeat itself, which it may not, we should start to see inflows across the rest of the altcoin sector and some of the more risk-on assets. It's very important for altcoin holders that Ethereum does well. That's cycle on cycle, that's a common theme. Ethereum dominance is climbing. It's now close to 15%, which in turn means Bitcoin dominance has started to subside a bit. Again, these are the hallmarks of bull markets in the future. ETF speculation and rising institutional flows are key demanding drivers. Doubling down even more on Ethereum, some more good news here. So Ethereum supply tightens. Exchange reserves are at a 9-year low. On-chain data shows that less Ethereum is available for sale, thus supply shock potential. When we have a 9-year low on the amount of Ethereum stored in those hot wallets on Binance, Coinbase, KuCoin, you name it, it is indicative of a general consumer sentiment whereby investors are opting to move their Ethereum into cold storage, move it into self-custody, institutional custody, whatever the case may be, that implies a longer term investment horizon, and it takes that short term sell pressure out of the market. This is a very bullish indicator. Post-merge ETH is also deflationary, where burns exceed issuance. The amount of Ethereum being burnt is greater than the amount of Ethereum being issued, new Ethereum supply coming in. In terms of supply-demand mechanics, that in conjunction with Ethereum inflows via ETFs, and in conjunction with Ethereum being pulled off exchanges, that does paint quite a positive, optimistic narrative for Ethereum. Supply tightening, demand from institutions, it's a positive feedback loop there. This could lead to sharp upside on thin order books. Key wallets now show ETH being accumulated. Whales, treasuries, and staking contracts are all absorbing more and more of that supply that's just been shuffled away to the side. Ethereum's in a good position. Back to Bitcoin and global liquidity. Look, the M2 correlation remains high. The M2 slide is probably one of the more spoke about measures and indicators used across the crypto space. Bitcoin performance highly correlated with M2 liquidity, broad money supply. More money in, Bitcoin goes up. Bitcoin is becoming somewhat of a deflationary hedge in terms of its recent price performance. With the debasement of the US dollar and a lot of foreign currencies, Bitcoin is seeing itself as that digital gold, limited supply, safe haven asset that consumers are starting to flock to, hence the all-time highs in Bitcoin. As liquidity expands, Bitcoin tends to rally. Bitcoin is a barometer for global monetary policy and liquidity cycles. Liquidity, not just sentiment, is the main driver behind Bitcoin's strength. It's not just the news articles, it's the foundational economic principles that are often the cause of newfound rallies in Bitcoin. The deflation of the US dollar and the inflation of Bitcoin's value against the US dollar seems to be the real narrative that's being driven these days. Crypto is responding more to macro flows than to crypto native news. 2021 cycle, it was all about news headlines for cryptocurrency. Now cryptocurrency is in the basket of high-risk assets, with Bitcoin almost carved out in its own league as a blue-chip cryptocurrency, but it's being treated just like high-risk assets in other industries, such as high-risk assets in the S&P 500, the NASDAQ, stock exchanges around the world. As a result of that, we can see that major crypto news is unlikely to affect the prices of cryptocurrencies to the degree that it used to. It'll still impact it, but just not to the degree it did in, say, 2021 or the 2017 rally. Rather, we're in a situation where it's these macro headlines, tariff deals, geopolitical resolutions and conflicts, of course, interest rates, and just general kind of sentiment about the US economically surrounding the world. They're the things that are going to impact the prices here. One little extra note there, Bitcoin has historically front-run easing cycles. So it's historically peaked 6 to 12 months before Fed hikes. In 2021, that was the case. So Bitcoin actually front-run the Fed and hit these new all-time highs before rate cuts really started to take off. That was when the altcoins started to get that real love and price performance. So maybe that happens again, maybe it doesn't, but something worth noting. So the September effect. In this diagram here, green equals good, red equals bad. We've got various months across various years, dating all the way back to 2013. The crypto market's very, very, very young, and we've only really had a highly liquid, high trade volume market for really only 7 years or so now, I would probably say. Since probably 2017, 18, that's really the only window of a very liquid crypto market. Of course, back in 2013, the prices were far less and interest was far less. So you can adjust your interpretation of this as you see best fit. What is interesting though is, there's no denying that September is historically one of the worst months for the cryptocurrency industry. That being said, October is historically the best month. In fact, we've only ever had 2 red Octobers, the last of which was in 2018. So we're looking pretty good for our October. September, though, we might have to kind of put the brakes on a little bit. Again, this is what history has shown. Whether we repeat it, we will see. But we definitely have some key drivers in September that could turn this around. September 17, we do have the Fed rate decision, which could be a highly catalytic event for the space. We could see a revision of narrative-driven rallies where certain things do very well while the rest of the market is stagnant. Altcoins are vulnerable if Ethereum and Bitcoin stall. If we continue to see Bitcoin stagnating and Ethereum doing the same, it's unlikely that we're going to see colossal gains across the more risk-on altcoin sector. But look, narratives remain powerful, and despite historically September being a poor month, there are a lot of things that really could do well. Ethereum layer 2s might get a run, real-world assets, RWAs, deep in sectors, DeFi. There's a lot of narratives that you can draw an argument to suggesting they're on the brink of that next wave of performance. A little note here, in 7 of the last 10 years, crypto is corrected in September. That's often been driven by macro shifts or post-summer rebalancing. So this may be a broader macro thing that just happens to slice cryptocurrency into it as well. All right, so looking further ahead, 3 major ones here. We've got September 17 Fed rate decision. This could confirm or derail current market pricing. If we see rates being held, we're probably going to stagnate a little bit. Maybe it could give us some more buy time for an extended bull market, or it could really start to pull us down. If rates are cut aggressively, we could really shoot for the stars. So it could really go either way here. September 30, US crypto legislation deadline, stablecoin and KYC rules may emerge as a result from that. Crypto specific may not make major differences in price volatility, but nonetheless, it is indicative of what the future landscape of the political view on crypto may be. November 10, a little bit later, is a US-China trade deal deadline. That's going to have broader macro implications that will undoubtedly cause shockwaves of volatility, either north, south, east, or west for the cryptocurrency space. High impact month, narratives can swing aggressively. Keep portfolio positioning nimble and stay close to your broker and have a plan in place. When it's super volatile like this, you want to have a general idea of what kind of outcomes you'd be happy with, so you can structure your assets and structure your sell targets, buy targets to reflect that strategy. If you fail to plan, you plan to fail, which I think everyone always says. So you get the point there. As we get into some final thoughts here to wrap this up, Ethereum's strength leads the narrative. Fed decision is a key catalyst to look forward to in the future. Liquidity remains the market driver. M2 money to supply is something worth kind of keeping the tab open on your computer. Narratives likely fuel selective alt runs. We're not necessarily going to get this colossal all ships rise bull market like 2021. It looks like a lot of things are going to be more selective this cycle. That means some coins are going to underperform Bitcoin dramatically and not do well. There will be a few that will outperform Bitcoin and do extremely well. So do your research, stay disciplined amid volatility, keep in touch with your broker, make sure that your coins are safe. All is good. Hope this has been helpful, and until next time, thank you.